Okay, welcome to lesson 7, Bull Flag Surfing Strategy. This is one of my favorite strategies that I trade every single day. In fact, there's almost a trade almost every single day, and it's one of my favorites because it's got one of the highest win rates and it's one of the most profitable strategies which I use. So first of all, let me define it. It's a strategy that seeks to go long on forex pairs that show a bull flag pattern while surfing the 6 or 18 exponential moving average on a strong uptrend. At the same time, we're going to go short on forex pairs that form a bull flag pattern, surfing the 6 to 18 EMA on a downtrend, respectively. So a few questions we have would be: number one, what the heck's a bull flag? Number two, what's surfing? So we'll get into that in a short while. So first of all, some of the program stats. I trade this on the 50-minute candles because it gets me in and out within less than an hour usually. I can take anywhere from one trade to even sometimes 3 to 4 trades a day. Profitable on most days, always end up profitable by the end of the month. Okay, now how often does this strategy or this setup occur? Pretty often actually. In fact, almost every day you see it occur easily 5 times on various pairs. But it doesn't mean that I take every single setup. I only take the ones with very high probability. So I usually take about, on average of 1 or 2 a day, sometimes 3 a day. But of course, there are days when I don't see anything that has high probability and I do not take trades on certain days, right? So it doesn't mean that every day you have to take a trade. There are certain days when you look at the market and there's no great setup, you don't take any trades. And on certain days, they all come at the same time and there's so many trades to take. So never chase the trade, let the trade come to you, and only take the high probability ones. So I'll say that on average, you're going to have about 10 to 30 high probability trades a month of this strategy. Okay. Now this works on all forex pairs, but again, I trade the 8 major pairs and their crosses. So things like your pound USD, Euro USD, dollar franc, dollar yen, dollar CAD, Aussie dollar, pound franc, pound yen. All the different combinations, right? And again, very importantly, we want to use brokers with tight spreads between the bid and ask spread of maximum 1 to 2 spreads. Okay, so this is kind of like what it looks like on the long side when we go long. This is surfing the bull flag on the long side, and this is surfing the bull flag on the short side. So again, I know some of you have questions like, what's a bull flag? What's surfing? Let's get into that right now. Well, first of all, let me define what a bull flag is. In fact, you know what? Even before that, let me talk a bit about what surfing means, right? Now, very often when you look at the currency prices, they look very erratic. They're going all over the place. It goes up, goes down, and something's really hard to know where the heck it's going, right? But there are certain pockets of time when you see that the price behaves itself, when it's moving in a very predictable manner, and it's kind of like surfing one of the moving averages. And what do I mean by surfing? Take a look at this chart on the left, okay? So you can see that at this point of time, again, it doesn't happen all the time. It happens during pockets of time. So you have to look out for those pockets of time, right? So during this particular time period, you can see that the currency pair was kind of like surfing this red line, okay? Can you see this red line now? That red line, this red line is a 6 exponential moving average. And this blue line is the 18 exponential moving average. Okay. Now, sometimes the price likes to surf on the 6. What do I mean by surf? What I mean by surf is you can see the candles is kind of like finding support at the 6 moving average. Can you see that? Every time it goes to the 6, it kind of like bounces off, bounces off, bounces off, bounces off. Okay. And when I talk about surfing, right? I mean, there are many ways you could surf. It could be sometimes the body of the candle is above the moving average and the lower shadow kind of like touches the moving average, right? And that's fine, that's a surf as well. Sometimes it could be that, again, that happens again. You can see the body is above the moving average and the lower shadow cuts below the moving average. That's a surf as well. Sometimes the price may open below the moving average and close above the moving average, like so. Opens below, closes above. Right? Sometimes it opens above, closes below, and then closes below, opens below, closes above. So this is what we call a very clear surfing yeah, I mean, it surfs the moving average, if you will, all right? You can see, so it's surfing it and it's going up. So you can see that this is an overall uptrend, as you can see. And again, you've learned, how do you define an uptrend? Uptrend is defined as higher highs and higher lows. And you also know that on an uptrend, the smaller moving averages are always above the bigger moving averages. So the 6 above the 18, 18 above the 50, 50 above the 200. So that's a very clear uptrend. Now on the right, you can see a clear downtrend. Okay, so again, on a downtrend, the moving averages are in the opposite sequence. You have got the 50 moving average, which is this blue line over here. You've got the 18 moving average, and you've got a 6 moving average. So it's, again, the biggest moving average to the smallest moving average, that sequence, okay? And making lower highs and lower lows. And over here, you can see that, again, it is surfing on the 6 EMA, right, which is this red line. So you can see it's surfing very nicely. That's called surfing. So it touches it, it goes, touches it, it goes, touches it, it goes, right over here, touches it, it goes. So that's what I mean by surfing. And again, we're looking for those times when it surfs the 6 moving average or it surfs the 18 moving average, okay? So understand surfing right now, okay? Hope you understand that, right? So once you understand the concept of surfing, let's understand what's a bull flag pattern. Okay, first of all, let's look at a bull flag when we're going long, that means on an uptrend, okay? So when we're on an uptrend, we're looking for a long bull flag. And this is what a bull flag is, basically, all right? A bull flag consists of impulse candles and corrective candles. Okay, first of all, what's an impulse? An impulse is a movement in the direction of the trend, okay? So in this case, it's an uptrend. Okay, it's going up. So the impulse candles are the candles that are moving up. Okay, so these are candles in the direction of the trend. And there are a series of candles making higher highs. Okay, so if you take a look at these 3 candles, 1, 2, and 3, these are the impulsive candles. Why? Because they're going up in the direction of the trend, which is the uptrend, okay? And you can see that this high and this high and this high is making higher highs. So we call this the impulsive candles or impulsive wave. Now, why does this happen? This happens because people are buying, all right? So they are buying and pushing the price up, right? They are buying, 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 buying. So you're seeing that impulse is going up. Now, like I said, it can't go up forever. It's got to come back down before it continues going up again. So again, remember that breathing pattern. Breathes out, breathes in, and then breathes out again. So after the series of impulsive candles, we're then looking for the corrective candles. And the corrective candles are candles that are moving opposite in the opposite direction of the trend. So in this case, the trend is going up and the corrective candles are coming down. So it's making lower highs. You can see series of candles making lower highs. So you can see that this high, this high, this high is making lower highs, and lower highs. So this is what we call a bull flag pattern. Why? Well, if you think about this, this is kind of like the flagpole. Right? It's a big flagpole over here. Okay, and this is kind of like the flag. So can you see a flag right now? Okay, that's what we call bull flag. Okay. Now, what is the psychology behind the bull flag? Okay, let me just get rid of all these drawings over here. Okay, so here's the psychology. The psychology is that on an uptrend, all right, we have got the impulsive set of candles, which means the price is going up. Okay, so as it's going up, people are buying, right? They're buying the currency pair. Now, after they buy, what happens is you want to see some profit taking, right? Some people taking profits, so that creates what we call the corrective candles. And what we want to do is we want to enter just at the beginning of the new impulsive wave. Let me repeat that again. We have got an impulsive wave, we have got a corrective wave, and we're going to enter a buy right at the start of the new impulsive wave. Okay? So how do you know the new impulsive wave is starting? The answer is when you see the price making a new high. Making a new high. As you can see, during the corrective candles, it keeps making lower highs. This high, and this high, and this high, right? It's making lower highs and lower highs and lower highs. We're looking for a higher high. So the moment the price goes above the high of one of these candles, right, in this case, you can see that over here, it makes a new high. We want to enter right at this point here. This is the buy entry, because usually what happens is when a new high is reached, it tells you that the trend is now continuing. Because we're on an uptrend, we are going to go long, okay? Now, what's very important is also we want to enter when the corrective candles are pulling towards the 6 or 18 moving average. Let me say, so which one do I want to look at? Do I want to look at the 6 or the 18? It depends. If it's surfing the 6 moving average, when you see it's surfing the 6, it's touching and going, we want to see that the corrective candles go back to the 6 and we enter at a new high. If it's surfing the 18 moving average, wait for the candles to correct to the 18 moving average, make a new high, and re-enter. So you have to see which one is it surfing, the 6 or the 18 moving average. Okay. Now here are a few rules for a bull flag. Okay, one of the rules is that the corrective candles should not break below the surf or the surfing wave, which is below the 6 or 18 moving average. So again, if it's been surfing the 6, it cannot break below the 6. If it's been surfing the 18, it cannot break below the 18. Now it can go below it and come back above it, that's fine, right? But what I mean is that when you see the entire candle body going below the 6 or the 18, it's no longer surfing it, it's not a valid trade anymore. Okay. Now the other thing to again understand is that on an uptrend, when we're going long, you have to see the sequence of moving averages. The 6 EMA above the 18 EMA, and that's above the 50 EMA, and it's above the 200 simple moving average. So let's take a look at what it looks like on an actual chart. So over here you can see the actual chart, the screen capture of it, and you can see that at this point of time, it's surfing the 6 or the 18. Take a look, right? That's right, it's surfing the 6 moving average. And again, if you can't see, this red line is the 6 moving average, this blue is the 18 moving average, this is the 50 moving average, and that's the 200 moving average. Okay, so over here you can see that it's been surfing the 6 moving average, right? Surfing it, right? It's touching, going, touching, going, touching. So it's surfing the 6 moving average. That's pretty clear. Okay, and so we want to see it surf for a while, right? To know that the 6 is a strong support. And then we're going to see the bull flag appearing. So can you see the bull flag? Here's a bull flag, right? So this is the impulsive candles, right? I guess you could take this one and this one as the impulsive candles. And again, how do you know it's the impulsive candles? When you see it going up, making higher highs. So you can see this high and this high, making higher highs. So these are the impulsive candles. Again, these are candles in the direction of the trend, and these are series of candles making higher highs. Now, oftentimes, the impulsive candles are bullish candles. They're green candles. Now, must they be green? Not necessarily. They could also have some red candles inside of them. You could have red candles, but most of the time they are green candles because they're going up. But again, you could have one red candle or two. Okay, so in this case, you can see this impulsive wave going up, and then you've got the corrective candles. And again, the corrective candles are now making a series of lower highs. Okay, so you can see from here you have from this high to this high, so there's higher high, higher high. So impulsive candles. That's your flagpole. Okay, and once you reach that highest high, you start to make lower highs, lower highs, lower highs, lower highs, lower highs. So you're looking for those lower highs, right? So this is your flag. Okay. Now again, your corrective candles are often red. They are bearish candles. But again, must they all be red? No. You could have some green candles inside. Like you can see, this is a green candle, right? So again, we're looking more for the pattern of lower highs than the color of the candle. Okay. Now the question is, when do you get in? All right, now you're waiting to get in the moment you see that one of the highs is breached. That means you see, once you see a candle making a new high, you enter the moment a new high is made. Okay, but you have to wait for the corrective candles to go towards that surfing wave, either the 6 or the 18. So in this case, you can see that it's surfing the 6 moving average. So you want to see the corrective candles going to the 6 moving average. If it doesn't reach the 6 moving average, you do not enter yet. All right. So you can see from here, it makes a new lower high. All right. Now again, it's far from the 6, so we can't enter yet. And again, over here, you can see makes a lower high. Again, it's far from the 6. Lower high. Not yet. Lower high. Okay. Now, the moment you see this candle, you can start to get ready to enter the currency, right? Because you can see that it's now touching the 6, right? It's at the 6. So what I do is once I see this, okay, I'll place my buy order just above the high of this candle over here. Just above the high. A buy stop order. So the moment the price goes above the high of this candle, it triggers my buy order and I'm in the trade. Okay? So I place my buy, I repeat, I place my buy stop order just above the high of this candle. Now you have to look at the spread. If the spread is 1 pip, then you put it 1 pip above. If the spread is 0.5 pips, you put it 0.5 pips above. So depending on the spread, okay, of the bid ask, okay. So in this case, I repeat, I put my buy order over here. I'm gonna talk about a stop loss in a while, right? So just hang on for a while. So that's my buy stop order, okay. Now what happens? The next candle makes a lower high again. So because of this, does this buy order get triggered? It doesn't get triggered because it only gets triggered if a new high is made, if the price goes above this level, right? So once I see this candle, what do? I will then cancel this order, and now I place a new buy order above the high of this candle. Got it? All right, great. Now, what happens to the next candle over here? The next candle opens here, as you can see, opens here, and it goes up, and it exceeds the high of this candle, and it triggers my buy order. So it triggers the buy order. I'm now in the trade. So that's my buy entry when a new high is made. So I buy exactly at this point, and I'm in the trade going up. And it'll hit my profit target somewhere over there. Got it? So that's the concept. So again, remember that for a long trade, you're looking for a clear uptrend. The 6 moving average above the 18, 18 above the 50, 50 above the 200. So how do we set up the charts? The way we set up the charts is actually the same as the first strategy that you've learned, which is the impulse pullback strategy, right? So we use similarly the 6, 18, and 50 exponential moving average and the 200 simple moving average. The only difference is we're going to add in another indicator known as the ADX, and we're going to use the default 14 setting. Now the ADX indicator is just a guide. This indicator helps us to know when we have a strong uptrend or a strong downtrend. And let me show you how it works right now and how to set that up in your charts. Okay, so we're looking at the charts again. And again, I'm using my MT4. I'm looking at 15-minute candles. And again, okay, I'm looking at the Euro USD pair right now. You can see currently that's a spread, right? So it's 15837, 15839. So the spread is very tight. It's the spread is not even 1 pip. In fact, it's zero. In fact, it's like 3 fractional pips, right? 0.3 of a pip. So very tight spread. So that's the best time to trade actually. Okay, so as you can see, we are using the same moving averages as the impulse pullback. Okay, so you've got the red line, the 6 EMA, the 18 EMA, the 50 EMA, and the 200 SMA. So it's exactly the same. The only difference is, again, we're going to add in a new indicator. Going to put insert, indicators, trend, and look for ADX, the average directional movement index. This is the one, right? So click on that. Period, change to 14. Okay, and click OK, and there we go. So this is your ADX indicator. Now I'm not going to go into the mathematics of it, right? That's not important. All you got to do is to look at this black line, right? I know you can see actually 3 lines. You can see this. There's this brown line, there's a green line, and there's a black line. I'm only interested in the black line, which is the ADX, right? The average directional movement index. Okay, and simply all I want to do is this. Hold on, let me just get back to the ADX over here. Let me just delete that. Let me do that again. So insert indicators, trend ADX. Okay, so period 14, right? Style black, levels. I want to add a level, which is 25. Okay, go to levels, add 25. You can put red if you want. Okay, there we go. So what this does is it puts a red line at 25. Okay, now why 25? Okay, basically, here's the simple gist of it, right? Whenever the black line is above 25, it tells you it's a strong trend. Again, it could be a strong uptrend or strong downtrend. It doesn't matter. Okay, so if you see that, like over here, you can see that the trend is going down, right? Let me just, yeah, right. So the trend is going down, right? And the ADX, which is the black line, is above 25. So this tells you that this is a strong downtrend, okay? At the same time, you can see over here, the trend is going up. And the ADX is above 25 as well. So it's a strong uptrend, right? So basically, when we are doing any kind of trend following, right? Whenever we are following the trend, ideally we want the ADX to be above 25, because above 25 means it is trending. It is trending, either up or down, whatever, okay? When it's below 25, it's kind of like moving sideways. The trend is not clear, right? So obviously, when we're surfing the bull flag, we want to do it during a strong trend, be it an up or down trend. So whatever the case, whether we go long or go short, we want to look at the ADX above 25. Got it? Okay, great. Now, so let's take a look at the Euro USD and see if you can spot those times when it's surfing the 6 or 18 moving average. Can you spot a time when it's surfing it? All right. Oh, there we go. All right. So over here, this point of time, you can see that it was surfing. Okay. Now over here, you can see it's kind of like surfing the 6. Yeah, it's surfing the 6. Then it surfs the 18 over here. Okay. Would there have been a potential entry point? Let's take a look. Okay, so you can see it's surfing the 6, and I'm looking for a bull flag pattern. Do you see a bull flag pattern? Okay, well, this is a bit of like a mini bull flag. All right, why? Because you see this impulsive candles going up. There you go, right? So higher high, higher high, higher high, and you've just got one. So you've got 3 impulsive candles, right? And 1 corrective candle. And that's fine. You can have 1 corrective candle, no problem, right? So take a look. So this high, higher high, higher high, and lower high. So the moment you see that the corrective candle goes to the surf, which is the 6, right? You can place the buy order over here, right? And your stop loss would be just below the low of the candle. Right, so that's your buy order, that's your stop loss. And the distance must be at least 8 pips. And I'll talk more about that in a short while. So what happens in the next candle? The next candle, does it trigger your buy order? No. Why? Because it makes another lower high. Right? So from this high, lower high, lower high. So it doesn't trigger your buy order. So what do? That's right, you cancel your buy order. Cancel the buy order. And you place a new buy order above the high of this candle over here. Right, so now this is your buy order, and your stop loss would be not here, okay, but it will still be here. So the stop loss must be at the lowest point of the corrective wave. Right? So that's your buy order here. This is your stop loss over here. Okay? And again, this is what is known as your 1R, right? Your risk, your trade. Okay? So what happens? The next candle, it makes a new high, right? So it goes up above the high of this. So it triggers your buy order here. So you buy here, and it goes up and it hits your profit target, right? Because you're risking, remember, you're risking 1R to make about 2R, right? There you go. So this was a winning trade. This was a bull flag, okay? Now, could this have been another bull flag? Yes, this could be another bull flag, right? So you can see this is an impulsive wave, right? So making higher highs and then lower highs, right? Lower highs, okay? Lower highs. So at this point, you could put your buy order over here. Your buy order could be here because it corrected to the surf, which is a 6. Now it didn't get triggered, it made a new low. So now your buy order would be here. That's your buy order here, and your stop loss is over here, right? There you go. So you buy and stop loss. So the next candle, does it make a new high? Yes. So it triggers your buy order. So again, you're buying over here, and does it reach your profit target? It may, depending, right? So you could risking 1R to make, I'm not sure if it reaches. It could have reached, right? If not, it would have been a losing trade, and that's fine as well. So boom, hits your profit target, you get out before it corrects down. And again, you don't always have to aim for 1 to 2. Sometimes you can aim for 1 to 1.5. Right? So again, I'll give you insights of when we aim for 1.5, when we aim for 2. It really depends, right? And this, if you aim for 1.5R, would definitely be a winning trade. So that was on the long side. Let's go back and see if we can find any more examples of this. See, this is not a clear surfing, right? It's like, see, first of all, the moving averages are not in sequence. Remember that for an uptrend, you have to have the moving average in sequence. So there's no sequence here. Now over here, you can see there's a sequence, right? The 6 above the 18 and so on and so forth. But you can see that over here, what's happened, right? It's kind of like, it's not surfing the 6 or the 18, right? In fact, it's surfing the 50. Now, for this strategy, we only want to surf the 6 or the 18, not the 50 moving average, okay? So that's not a clear surf. Let me find a clear surf for you, all right? Yeah, okay, this over here, it's a clear surf, but this is a downtrend, right? So you can see surfing the 6, surfing the 6. Can you see? Very nice, it's surfing the 6. Now over here, it is already broken above the 6 moving average, so it's no longer surfing anymore. So it's from here, let me show you where it was surfing on the short. I would say it was surfing from here to, yeah, there, this period over here. This was surfing the 6 moving average, right? You can see touch and go, touch and go, touch and go, touch and go. So this is the period where you're looking for a bull flag. You're looking for a bull flag. Was there a bull flag? Again, I've not taught you the short bull flag yet, so I'm going to skip this. I'll come back to this in a short while to show you. But just to let you know that this was a bit of a bull flag. So you can see over here, this was the flag pull, flag, sell, continue. Right? Again, I'll talk more about that later on. I've not taught you the short bull flag yet. Now over here, let's take a look. Yeah, it was surfing the 6 here again, right? So you can look for bull flag over here, surfing the 6, bull flag over here as well, right? So I want you to practice looking for times when it is surfing the 6 or the 18. Go to another. Now this was again a period here when you're surfing. Hold on. Okay, so over here you can see that it was surfing the 18 moving average. Right, clearly surfing the 18 moving average. Right, so this was a surf of the 18 moving average over here. Right, now this could have been now question, would this have been a bull flag entry? Not really. Okay, why? Because, okay, now over here you can see the impulsive candles, right? So it's again making a higher high, higher high, higher high, right? Now this makes a lower high. So it's the beginning of the corrective candles, right? Lower high. But would we enter here? No, because it's far from the surfing EMA, which is the 18. So we'll not enter over there. Now the next candle already makes a new high, right? So once it makes a new high, it is no longer a bull flag, right? Remember, a bull flag must make lower highs, lower highs, lower highs, lower highs, all the way to the 18 or the 6. But in this case, it did not do that because before it could go to the 18, it already made a new high. So this would not have been a bull flag over here. You understand? But this, let me just take a look. But this would have been a bull flag. This part over here is a bull flag. Why? Now, this is the impulsive candles, right? This high to this high. Higher high, higher high, right? And then lower high. So this is the corrective candle. In fact, this only has one corrective candle. And within one corrective candle, it's gone back to the 18. So this is a potential entry. So I'll put my buy order over here and my stop loss over there. Now what happened to the next candle? The next candle made a new lower high. So it did not trigger the buy order, right? So I'll cancel this buy order once it's not triggered. A new buy order is here. Let me just do that again. A new buy order will be above the high of this candle. That's my new buy order. My stop loss will be somewhere over here. So again, this is my 1R. Okay. Next candle makes a new high, triggers my buy order, boom, goes up and definitely hits my profit target. So this was a valid entry, but this was not because of the fact that it made a new high over there, right? So I do hope that that makes it a bit clearer for you on how I identify these bull flags surfing on an uptrend. Let's go back to the charts, or let's go back to the slides. We're back on the slides. So if you got a bit confused when I talked about where I bought, where I put a stop loss, no worries, I was jumping ahead to kind of like preempt you to the exact entry and exit rules. So let's go through the rules right now for the bull flag surfing long setup. Okay, so these are the entry setup rules. And again, you have to follow this strictly. No exceptions, okay? So first rule, number one, we want to see that the pair is on a clear uptrend. So again, you have to see the moving averages in sequence. 6 EMA, above 18, 18 above 50, 50 above 200. And like all other strategies, whenever we're trading on a certain time frame, like I'm trading on the 15-minute time frame, you always want to check one time frame higher to ensure that the higher time frame is aligned to the lower time frame. So once I see that the 15 moving average is on a clear uptrend, I also want to ensure that the H1 candles, the hourly candles, are also on the same clear uptrend pattern. Okay, so that's really, really important. Next, I want to ensure that it's a strong trend. Again, doesn't matter whether it's an uptrend or downtrend, it must be a strong trend. And to help me, I look for the ADX indicator to be above 25, telling me that the trend is a strong one. Next, I'm looking for a strong support, which means I'm looking for the candles surfing touch and go surfing off the 6 moving average or the 18 moving average. It's going to surf one of them. Now, once I can see it surfing one of the moving averages, I'm looking for a bull flag pattern. So what's a bull flag? It's a series of impulse candles making higher highs, which I mentioned earlier on, followed by corrective candles making lower highs. And again, it must make lower highs and reach the 6 or the 18 moving average, whichever is the strong support. Okay? Now, what's important is that when you have got the impulsive candles, let me just draw it for you one more time. Okay, let me just draw it here. So again, over here you can see the impulsive candles, right? And it starts from here because this is a high, it's a high, it's a high. So it's higher highs and higher highs. So these are my impulsive candles. All right. And once I have that, I want to see the corrective candles, right? So this high, lower high, lower high, lower high, lower high. So I'm looking for lower highs until it reaches, again, the 6 or the 18. So which one do I look for? In this case, you can see it's surfing the 6 moving average, right? It's surfing the 6. So I want to see it go to the 6. So in this case, this is the candle over here. You see this candle over here? That's the one that I'm looking for because it has reached the 6 moving average. Okay. The other thing that I must mention would be that, let me just clear this away. Okay. Now, ideally, if you look at, like I said, this is a flagpole. Imagine this as a flagpole. Okay, that's the flagpole. And imagine if this is 100%. Okay. Ideally, I want to see that the corrective candles retrace no more than about 62% of the impulsive wave, right? So if it retraces here, it's like it goes up 100%, it goes back down 100%. That's not a good bull flag. I want to see that. Okay, let me draw. This is a flag, right? It's a flagpole. This comes with a flag, right? So if you think of this flagpole to be 100%, okay, I want to see that the corrective candles retrace to a maximum of like 60% or 62%. Okay, before going higher. If it goes more than 62%, not that great. All right, that's my favorite. I like 62%. Again, if you understand Fibonacci, is what we call the Fibonacci level, or rather it's 61.8% to be exact. Okay, and again, more importantly, the corrective candles, it cannot correct below, it cannot go below the 6 or the 18 moving average. Okay, so for example, if it went like that, if it went like that, below the 6, that's no longer a valid, no, because it broke below the wave. Okay, do we understand? Good. If you don't, send me an email. Check it out. You gotta understand that. Okay, great. So let's continue. So once we see that pattern, we'll place a buy stop order just above the high of the last corrective candle that touched the 6 or 18 moving average. And again, we place it just above the high plus the spread. Again, whether it's 0.5 pips or 1 pip, right? And we place the stop loss below the low of the corrective candle that is near the 6 or 18 moving average. And we repeat this process until the buy order is triggered by a new high in price. All right, so actually I've explained this, but this is the formal definition. Okay, now recall that a buy stop order means you're buying above the current price, right? So only when the price is reached will your buy order be triggered. Okay. Again, Like I mentioned, if the corrective candles go below the start of the impulsive wave or below the moving average support, the setup is no longer valid. The distance between the entry price and the stop loss is known as 1R. And your 1 hour distance must be at least 8 pips. It can be more than 8, could be 9 pips, 10 pips, 20 pips, 30 pips, it's fine. But it must be at least 8 pips, no less than 8 pips. And we then place a profit target 1.5R to 2R above the entry price. Okay. So again, let's take a look at this example. So we're looking at Aussie yen. This is a currency pair. 50-minute candles, and again, you can see it's surfing the 6. Can you see it's surfing the 6? Right, touch and go, touch and go, touch and go. So you want to see it surfing for a while, and then you see this is the impulsive candles, right? So 1, 2, 3, 3 higher highs, and then you see the corrective candles. So this high to this high, lower high, lower high, lower high. So again, I'm waiting for it to correct to the 6. Now, over here again, you see this candle? It has corrected to the 6. So I can place my buy order just above the high of this candle. Okay, and the stop loss below the low of the candle, or at least 8 pips away, whichever is further. So say we put a stop loss somewhere here. So that's my buy order, that's my stop loss. Okay, so what happens? The next candle that appears, it makes another lower high. So it doesn't trigger our buy order. Because to trigger our buy order, it must make a new high. Remember that. Okay, so when this candle appears and it closes, we then cancel this order. And we now place a new buy order above the high of this candle, which is at 84.09 in this case. Okay, and we place our stop loss below the low of the candle, but at least 8 pips away. So in this case, our stop loss will be at 84.01. So the difference is 8 pips. So if I'm risking 8 pips, I want to make at least 1.5, which is about 13 pips, or 2R, which is 16 pips. So in this case, I'm aiming for 16 pips. 16 plus 84.09 is 84.25. So that's my profit target. So again, once I place my order, I place 3 orders: my entry price, my stop loss, and my profit target. So sure enough, the next candle opens here, goes up, triggers my buy order. So I'm in the trade at 84.09, right? And 1, 2, 3, 4, 5, 6, 7, 8, 9 candles later, it hits my profit target. So one candle is about 15 minutes. So this is kind of like about 1 hour, 2 hours, 2.5 hours, right? I'm out of the trade. So this is how this trade works. This is how this strategy works, okay? Now, here's an alternative way to enter this trade. So again, I've mentioned that when I see the corrective candles, right, I place my buy stop order above the high of the last corrective candle. Okay. Now, another way to enter the trade is using a limit order. Remember, you use a buy stop order when you want to buy above the current price, but you use a buy limit order when you want to buy below the current price. Okay. So sometimes, for some reason, you may be late to the trade. In other words, by the time you see it, the price has already gone above your intended entry price. It has already made a new high. Okay, so if the price is already here now, right, it's above your intended entry, which is at 84.09. So in this case, what you do? Okay, you now place a buy limit order, okay, at that same price, which is again at the high of the last corrective candle. So my buy limit order is now 84.09, but the price is currently at, say, 84.12, right? Like this could be 84.12. So I will only get filled, my order will only be triggered if the price comes back down slightly to 84.09, trigger my buy order and take me out. All right, so this is another way to enter the trade. In other words, the price is already moved above your entry price. You place a buy limit order. Hopefully, it comes back down to fill your buy limit order and continue going up. Now, sometimes it may not come down. It may continue going up, and then you miss the trade, and that's fine. If it hits the profit target without you, cancel the order, look for the next trade. Okay? But until it hits the profit target, you still have a chance it may come down to trigger your buy order before taking you to the promised land. Okay? So let's look at a few examples right now. So this pound Aussie on the 8th of June. So again, I'm looking at 50-minute candles, pound Aussie. And again, always check the H1 as well, hourly candles. So 50-minute candles on an uptrend, hourly candles must be on an uptrend. Make that a habit. Always do that for every strategy that you use, okay? So let's take a look. Do we have a clear surf? Yes. So in this case, you can see that it's surfing the 18, surfing the 18, surfing the 18, surfing the 18. And then it was surfing the 6 over here, all right? But because it was surfing the 18, I'm taking the 18 to be a stronger support. So I want it to come back towards the 18 in a way, all right? So again, you can see there are actually many bull flags that appear. So for this particular trade, I took it at this point of time. So again, you can see this was my impulsive candles. All right, this is the impulsive candles, higher high, and this was just one corrective candle, right, which was this pin bar. So make a lower high, and again it goes near my 18 moving average. Okay, so I place my buy stop order just above the high of this candle, which is 7446. My stop loss is just below the low of this candle at 7431. So what is my 1R? It is 15 pips. So do I have at least 8 pips? Yes, at least 8 pips. Good to go. So again, I'm risking 15 pips. My profit target could be 2R or 1.5R, right? Depending on how aggressive you want to be. You'll be more aggressive, go for 2. So in this case, my profit target will be 30 pips above my buy order. So 7446 plus 30 be 7476. So that's my profit target. Profit target, entry price, stop loss price. And again, look at your ADX. And ideally, you want it to be above 25. Right? So it's above 25, telling you that it's a strong trend. So the next candle goes above the high of my corrective candle, triggers my buy order over there, and boom, hits my profit target within 1, 2, 3, 4, 5 candles. So I'm out within about 1 hour and 15 minutes.